Good morning, good afternoon, good day. Welcome to my midweek market review, 12th May 2021. I am Sagar Nandi, retired IT professional, swing trading stocks using the Q systems and techniques. You may contact me using my email ID tradingprofitably@gmail.com. I regularly share live market and stock analysis on my website sagarnandi.com, YouTube channel Trading Profitably, and Twitter handle Sagar Nandi. You are most welcome to make use of them. Disclaimer: this demonstration is for educational purposes only. I am not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. These are the Q systems I use that I will use in today's session. I use in my live trading. They run on TradeStation and Metastock platforms. That was the last slide. Let's continue with the live system. We'll start with a study of the global markets. I'm using Q Global for that, running on Metastock, starting with Australian index AXJO. Today, AXJO broke below the trendline support with a bearish flow, magenta flow color candle in the daily chart. The weekly also flipped from cyan to magenta with an indecision indicator at the top. Daily displayed a bearish signal one day earlier. However, at that time it was above the trendline support. We would not consider taking short at that time. Today, at the market open, you could keep an eye on AXJO, and as it was coming down below the trendline support, you could take an intraday trade in the short direction. The day closed with a long lower tail, therefore Q traders would exit the intraday short position and not hold on to it overnight because of the long lower tail. It is in an uptrend. Certainly in an uptrend, there are trend line supports nearby, both in daily and weekly. There is no swing short setup in AXJO right now. It was in an uptrend, however, it just broke below trend line support today. Japanese market Topix index. I will point to the bearish headwinds and let's see how many global or USA market instruments displayed the bearish headwind at or near the top. Topix displayed it at the very high. Since then, the backdrop color remained magenta. This week has a bearish shape candle, bearish color candle, and even more bearish is the reversal signal at pendulum high. The weekly is bearish. The daily is still in an uptrend. It does not have lower low, though it is having lower highs, doesn't have lower low yet. It broke one trend line support, broke both of these trend line supports actually. However, like the Australian market, Topix also closed with a long lower tail. Therefore, we wouldn't take a breakout short setup new trade entry today, looking at the long lower tail. It broke down below the trend line support. However, it has a long lower tail. Looking at that, we might close our long trades or protect profit in them, but would not take a short trade at the close of today's market. China market index CSI 300 continuing to remain within the trend lines resistance and support. Yesterday it held the support beautifully, and I keep on pointing to the weekly trend line support that is holding beautifully. This week also it tried to go below that, but as of today it is holding above the trend line support with a bullish shape candle. Once again, I first pointed to the possible support from this trend line around this point when price dropped sharply from the top. And price dropped after displaying a bearish headwind in weekly. Daily also had multiple bearish headwinds. In daily, it went above the bearish headwind and soon after that reversed, creating a false upside breakout. Therefore, CSI 300, you may say, also topped after displaying the bearish headwind. At the right edge, because of the very strong weekly trend line support, we are not considering any short trade. And also in daily, we'll have to wait for the daily trend lines to be broken before considering any short trade. For a long trade, I will wait for the trend line resistance to be broken. FTSE index now, UK market. This is also in an uptrend, displayed a bearish headwind here. After that, price came down sharply, displayed a bear release signal, very gradually moved up. The move up accelerated at the end, and now it has reversed below the watermark resistance after displaying an indecision at the top doji candle. Then came a bear release, very wide range bar yesterday that closed above the trend line support. Today that support is still holding. Remember, when price came near this point, around this area, there was a trend line support forming, and I suggested that we could buy fundamentally strong stocks at that time. We wouldn't buy FTSE itself because it was close to the upper boundary. However, looking at the memory trendline support, which usually hold pretty well, we could buy fundamentally strong stocks. And as of today, in spite of this wide range bar one day earlier, the trendline support is still holding. At the right edge, we wouldn't take any short trade because of multiple trendline supports in the daily. We will not take any long trade because the daily color is bearish. Lastly, India's Nifty 50 index. Here also the bearish headwind came right at the very top. Overall, it is still in an uptrend, at least in the weekly chart. In the daily, as I mentioned in several webinars, it is moving sideways. It's not in a downtrend. Today price came down, however, held above the trendline support. That was our study of the global markets. What do we see? We see that many of the global markets pulled back little bit, but that didn't change the overall trend to downtrend. All of them are in an uptrend. And one thing we noticed that bearish headwind came at or near the very top of almost all these instruments. Almost all. That is why we take the bearish headwind signals seriously. Now let's look at the USA market. Let's look at E-mini S&P 500 futures. It displayed a bearish headwind this week. In the weekly and the daily displayed multiple bearish headwinds in recent days. Those tend to precede a market downturn. That's why we are always careful when bearish headwinds come, especially when multiple bearish headwinds come in related instruments. And these are all market level instruments. Many bearish headwinds came in them, so you would be careful. There were also several indecision candles and bear release candle. Price pulled back little bit, however, it is holding the trend line support in the daily chart. Therefore, we could be cautious, but we would not take any short trade unless these trend line supports are broken. That is at the market level. Individual stocks will of course give bearish trade setups before these trend line supports are broken. If we look at SPY, the ETF also displayed a bearish headwind at the very top. The current week displayed multiple bearish headwinds in the daily as well. Several indecision at the top, orange candles, orange dots, and bear release signal here and here. Yesterday price dropped, however, stopped right at the trendline support. Displayed an indecision at the bottom indicator yesterday. Today's market is not open yet. We'll see if these two trend lines hold or if they are broken. If they are broken, it will be bearish. If they hold, that will be bullish. Overall, it is certainly in an uptrend. Nasdaq ETF QQQ. Earlier, we saw using internal studies that Nasdaq was weaker. We'll see if that is still true today. The ETF itself displayed multiple bearish headwind at this price level. After that, price tried to go up but failed at the watermark resistance created by the bearish headwind, creating a false upside breakout. The weekly also displayed bearish headwind here. Then price tried to go up above the watermark resistance and came down, creating a false breakout in the weekly as well. Weekly has trendline support. Yesterday price tried to go below that but closed right above the trendline support. That created this gap down but then moving up candle that gave a gap long day trade setup. In the daily, we can see it is moving sideways now. Unless this trend line is broken, we'll avoid taking short trade in QQQ. We can see price came down with heavy volume for 2 days in a row. And if we look back, the last time that happened, that is price came down for 2 days in a row, very high volume, shown by the dots on the activity bars. Last time that happened was here. That was early March. And then it happened again in mid-May, March, April, May, 2 months, after 2 months. Unless this trend line support is broken, we'll say it is continuing to move sideways. Dia, again it displayed a bearish headwind this week. It was strongest of the market ETFs in recent weeks. Weekly has a trend line support. Daily displayed a bearish headwind. Price tried to go up but reversed and about to create a false upside breakout. And as you see these examples, how bearish headwind can lead to a price drop in instruments. The drop may happen immediately or price may try to go up first and then comes down creating a false breakout. That is why the bearish headwinds are often used by traders to take short vertical trades. By taking short verticals, time is in a trader's favor, and even if the price goes against us for a few days, we don't have to stop out of the trade. We would stop out if we used the ETF or the stock, but if we used short verticals, short call vertical for a bearish trade, we would not have to be stopped out, and as price comes down again, we would make a profit in the trade. Time decay would be in our favor. And of course, if the price drops immediately, then we would make profit from delta move immediately after entering the trade. That is why when the bearish headwind comes, it is a reversal trade at the very top. The preferred instrument for Q technique is not the stock or ETF, but the short vertical. It is, of course, DIA of course is certainly in an uptrend. Unless these trend lines are broken, we are not going to take any short trade in DIA. So it looks like we have to wait for a long time, at least for swing trading purpose. For intraday trades, we may take shorts. In fact, I took a short trade in DIA yesterday, and I will explain later why. Let's look at IWM before that. Once again, IWM displayed bearish headwind at the very top in the weekly chart, and since then the backdrop color has remained bearish. Once again, a short call vertical would be appropriate. That trade would give large profit as price could not close above the high of the bearish headwind signal. In the daily, it is moving sideways. It has trend line resistance and trend line support is some distance away. It has watermark support also. It is currently right in the middle, so we would avoid taking any trade. As I mentioned earlier, I took several hedging short positions using IWM. You can see IWM could not go up. So if those trades were with short call vertical, I would make profit. If put vertical also, I would probably make profit when price gapped open down yesterday. In fact, I had a short put, no, not short put, sorry, on this day, that is Monday. On Monday, I took a long put vertical. Let me go to the intraday fine tune chart. Yesterday, I was watching all the market in, okay, because I was watching all the market instruments side by side. Let's come here. I am opening the TradeStation workspace with all the market instruments that I watch intraday using Q fine tune chart. On Monday I was watching all the instruments, and let me close UUP and USO, keep only the market ETFs. Now I can see more than one day's move on the chart. That's what I wanted to show. I was looking at all the market instruments and I saw here. This is what I saw. This is Monday's open at the blue pivot line. For all the instruments, and right in the first bar here I am using 10-minute interval. In real life trading in the morning session I use 5-minute interval using fine-tuned chart. See, right after the open IWM came down and broke below early range low. Dia after the open on Monday went up. SPY came down but held on to the early range low for a while. And QQQ also dropped. So I could take a short trade in the weakest of the 4 market ETFs. If I was going to take an intraday short trade, I would take in the weakest of the 4, which would be either IWM or QQQ. QQQ was weak for a while, so I chose IWM. Market has a tendency to rotate between these instruments. Once QQQ may be weaker, and then small caps may be weaker, and then Dow may be weaker. We are yet to see that, except probably yesterday. But this was Monday. This was my basis of taking a short trade on Monday. But I didn't take it as an early range breakout. I was slow in entering the trade. I had some other positions, some long positions also, and as the market was dropping, at least IWM was dropping and QQQ was dropping, I was managing those positions, and I took a short trade quite late in the day, maybe around this point, or maybe just before or just after it went below previous day's low, the major red pivot. Price was around say 222 at that time, and I took a very speculative trade, long put vertical with my long leg at 215 and short leg at 210. Why did I choose 215 and 210? I thought that price will continue to move at least for a few days, if not immediately. Over time, the option trade had about 40 days plus to expiry. So I had a large number of days in my hand, and I saw IWM on that day. If you see the price move from around 225 plus, it was already down by about $5 already in one day. So how I chose the strike? Another 5-day below current price. So I had 40 days plus to expiry, and I gave just $5 distance to my long put leg. So I was thinking, if another such down day happens, my out of the money long leg would become in the money. The further out of the money short leg will take time to be in the money, and when that happens, if price continues to go down, these speculative trades make a large profit in terms of reward risk ratio. Again, I didn't take extremely far leg as long leg, only $5 away. Okay, only because the day when I was taking it, it was already down by about $5 or more than $5. In fact, the day ended by even more, I think about $6 or $7 down. So in any case, I opened the long put vertical, a speculative one, because even the long leg was $5 out of the money and the short leg was 210. Why did I choose 215 and 10? Again, 215 because it was $5 away from my entry time, and I saw price was already down by about $5 on that day. So I just thought maybe another day of $5 down move will bring my long leg to be in the money. And why did I choose 210 as the short leg? Because the 210 leg gave me half of my long premium back. That is what I try to do when I take long put vertical or long call verticals. The short leg premium, I try to make it half the long leg premium. Very simple to follow, no complicated mathematics looking at delta, volatility, etc. The short leg should give me about half the price of the long leg for long verticals. And this is how I opened it on Monday. And see, on Tuesday it gapped open right at 215, right at 215. Okay, exactly. I am not, let's see, right at 215, open 21492, so just below 215. My long leg was in the money and I had, I think, about 40% profit in one day. Now I watch global markets, and I have mentioned earlier, one market tends to give some idea of what may happen in USA is India market. Not because USA market follows India market, but I guess India market opens before USA and India is heavily influenced by USA. So the overnight news, etc., they already play out. Psychology, everything plays out. I have seen that to be true. Of course, I am not going to take a trade in the USA market based on India's Nifty 50, but I keep the Nifty 50 picture in mind. I trade based on actual instruments move, but I keep the Nifty 50 picture in mind when I am trading in USA market level instrument. India's Nifty 50 on this day, that is Tuesday, opened lower and then initially moved up quite sharply. So what I did, right near the open, I didn't even wait for the early range breakout to happen to the upside. I closed my entire profit. One thing I have mentioned earlier also, if I take a simple call or simple put and on entry day or next day I have 50% or more profit, I book profit in the trade. Because simple put, simple call getting 50%, certainly getting 100% profit is unusual. If I hold on to the trade, the profit may erode very fast. So I tend to book at least partial profit, get my money back. In this case, it was a speculative vertical trade, long leg, substantially out of the money when I entered the trade, and I had the thought in mind that price may reverse at least in the beginning, and such reversals, if you are trading options, you would know, especially with out of the money options, but even for in the money, not deep in the money, but in the money, at the money, and certainly for out of the money options, profit erodes very fast if the instrument moves against us. So I had a 40% or so profit right at the open and I closed my entire position. That was a very good idea because on hindsight, of course, price went back up above the previous day's close. Though I entered the trade somewhat above the high of yesterday, by the high of yesterday, the trade would have gone into a loss. Instead of making 40% profit in one day, in couple of hours in fact, I would go into a loss. Eventually it came back and it would be in a small profit, but nowhere near the 40% that I would get from a gap down move at the open. That is how I traded IWM. I booked profit on Tuesday near the open, and then what did I see? On the daily weekly charts, we saw Dia was the strongest, but what happened yesterday? IWM sharply reversed. It gave a gap long day trade setup that ended out to be very profitable. Why? Because the entry would be around early range high, stop would be around early range low, and at the top the risk distance would be covered. So the gap long day trade was profitable. QQQ also gap down at the open, gave a gap long day trade opportunity. Entry would be at the early range high, stop would be early range low. At the high of the day, it covered more than the risk distance, so it gave a profitable trade again. Again, if I was trading instruments, market instrument, I would like to go along with the strongest ones for the intraday trade. So the strongest ones would be IWM or QQQ. Interesting, isn't it? These were the weakest instruments earlier, and on intraday basis they were the strongest. That is how the market operates. The strongest ones rotate to the weakest ones to the strongest ones. That plays out in the market instruments over shorter term, hourly period, or certainly intraday charts from day to day. Now I noticed that Dia gap down at the open like all the other market ETFs, but could not go above early range high. This was the only instrument that failed to go above early range high. Instead, it went below early range low. And Dia was the strongest of the market ETFs earlier, so it was likely that it would be weaker for a few days at least. So I took a vertical trade in Dia. Now I am holding a vertical trade in Dia. At the close, it has a small profit, not a big profit. We'll see what happens today. If it goes down, I'll try to book profit in Dia also. That is how I am using the market ETFs to take bearish trades, even though on the weekly, daily, at a glance charts, there is no bearish trade. I am using the intraday trades, and these trades, you may say these are hedging trades. They are allowing me to, for the most part, recover or maybe make even more profit than the losses made on the long sides. As of now, I have closed all my long positions. I am short-term trader. These accounts I am doing short-term trading, so I closed all my long positions. Currently, I have only one short position, that is Dia, that is a vertical trade. We'll see how the Dia does and how the market does. Now, coming back to the market instruments, they are not in a downtrend. At the max, we may say they are moving sideways. The last few days, it felt like market is dropping much. It didn't drop much. Now, I use market breadth analysis. I use that on intraday charts on Q Elite on TradeStation. This is the intraday market breadth. Let's see yesterday's market breadth. For Nasdaq, advanced decline opened low as QQQ gapped down at the open, then QQQ recovered and advanced decline recovered. If you see the up down volume, initially tried to go down but recovered and closed above zero line. That was Nasdaq. For NYSE, advanced declined opened lower, recovered somewhat but not much. And up down volume remained below zero line throughout the day. Near the close, selling increased. Russell 2000 opened lower for advanced decline recovered substantially. Up down volume went above zero soon after open and closed well above the zero line. That is why QQQ and IWM recovered fast. And when I traded these instruments, I was looking at the intraday breadth, these charts on a monitor. So I was ready to exit my IWM position, and see DIA opened with a gap down like the other instruments. See the advanced decline. Came down after the open and never went up. And see the, sorry, this was advanced decline. Came down after the open, never recovered, and the up down volume continues to go down. This is the pattern you may keep in mind. If advanced decline remains below zero, even if it recovers little bit, which it did not for DIA, but even if it recovers little bit, fails to go above zero, recovers little bit, or just stays low like it did yesterday for DIA, and you see up down volume is continuously going down, that is the weak instrument for the day. That also helped me decide to short DIA, not the other ones. See QQQ, this is Nasdaq 100. Earlier we saw Nasdaq as a whole. Now Nasdaq 100 advanced declined, opened lower, recovered and went above zero. Up down volume came down, didn't recover but moved sideways. And S&P 500 came down after open for advanced decline, did not recover. Up down volume also continued to go down. So I could have shorted based on the internals either S&P 500 or Dow Jones, DIA. However, when we look at the fine-tuned charts, extremely valuable for intraday trading or precision entry of swing trading, SPY could go above early range high, but DIA could not. Instead, DIA fell below early range low and stayed below early range low. So when I combine the intraday breadth with the movement relative to the fine-tuned pivot levels, the obvious choice was DIA. Now see what happened. In Q system on Q global addendum, we have the market breadth. Let's see the major indices market breadth, and this I can run only at the close of the day. This needs data from all the major and composite indices. Usually I don't show the daily, but let's look at the daily for 1 minute. I want to point to one thing. This is the Q global market breadth for the major indices: Dow Jones, Nasdaq 100, S&P 1500, S&P 500. Earlier, DIA was the strongest, but see the arrow here. This was an accumulation day in DIA, and yesterday what happened? It gave a distribution count. Notice that Nasdaq 100 actually didn't give any distribution count. S&P 1500, S&P 500 also did not give. So of course after the fact, but I am happy to see that the instrument that I shorted, that is the one that gave a distribution count yesterday. And if we look at the market breadth total view, we can see the distribution count there also. Yesterday in market breadth total view, that shows the total internal breadth from insights of Nasdaq, NYSE composites, and then S&P 1500, 500, Nasdaq 100, Dow Jones. There was only one distribution count yesterday, and that came from Dow Jones. So I took the short trade in DIA using intraday fine-tune chart, intraday Q Elite market breadth, and I am happy to see that at the end of the day only DIA gave a distribution count. What about the other market breadth studies here? If we look at the MA studies, percentage of stocks were 50 MA above 200 MA. That is for the total breadth. This is not for any single index. It is the total view, consolidating the data from the 6 indices. The percentage of stocks where 50 MA above 200 MA is at 80% level. Percentage of stocks above 50 MA, it has come down from the green line, which is 80%. It is now just above 60%, and it came below the average line. Percentage of stocks above 200 MA just crossed below the 80% and crossed below the average line. And if you see this zigzag line on the candle chart, that is 3-month new high low. I added that because I saw Dr. Jeffrey was using it regularly, and the way he reads it is every time it goes to the extreme, this study does not stay there, it pulls back. That clearly happened over last few days. Again, this is a consolidated view of the 6 indices. The 3-month new high low came down significantly. Here it ranges between 100 to 0. It is now below the 50% level. Is there bearishness on the market breadth total view? No. It gave a distribution count of only 1. No major market drop has happened without a distribution count of at least 2. That has not come yet. There are some weaknesses, but this is an important criteria I have seen. Without that, no major market drop has happened in the past at least. Not that future will always repeat the past, but it tends to do so quite well in the stock market. So I am not seeing that bearish signal yet. Nasdaq continues to be weaker in terms of market breadth, and let's spend 1 minute to look at the Nasdaq composite, at least the composite. This is market breadth study of the Nasdaq as a whole and then NYSE as a whole. I showed earlier that the percentage of stocks above 50 MA for Nasdaq was below 80% level for quite long time, even below 50% level for quite a long time. This is weekly interval, so this covers a large number of days. It in fact weakened further yesterday. Also, the percentage of stocks making new high, that was showing bearish divergence. In case of NYSE, you see the percentage of stocks making new highs steadily going up, no divergence at all. Whereas for Nasdaq, it was coming down, and the NYSE percentage of stocks above 50 MA was not coming down, but for Nasdaq it was coming down. These two weaknesses I pointed to earlier, and they are remaining. Lastly, we may have a look at mega cap top 20. When price was near upper boundary and it was displaying the indecision candles at the top, followed by a bear release, I mentioned I wouldn't buy mega cap top 20 even if I could buy it as an ETF. It is not an ETF, it's a custom index built by Q Global System. Very smart developers. Some people say so. Now see, it has pulled back. So the decision not to buy at the top, it tends to play out many more times than not. We like to buy in Q technique at the swing low. Breakout trades also are there. That is also there as a setup in Q system, but I also like to trade the swing low, not the swing high. That is not my preferred place to take long trade. That would be useful in this case also because mega caps pull back. closed above the trend line support and the yellow direction line. So I wouldn't short it unless this trend line is broken. And if this trend line is broken, there is another trend line nearby. So it will not be in a downtrend anytime soon. Doesn't mean if you continue to hold your long positions, their profit will not erode, but it will not be possible to take a bearish trade in many of the instruments anytime soon, neither in the market ETFs nor in the mega cap stocks. When I say anytime soon, of course, market can prove that wrong by having a huge down day in one day or huge down move in a couple of days. But looking at the price moves of recent weeks and months, it doesn't seem like we'll have many bearish easy trades in a few days time, especially because we see there are trend line supports not only in mega cap to F20 but trend line supports in multiple market ETFs as well. That was a look at global market and USA market. Market level is always important, and I spent more time this time explaining how I took the intraday trades that neutralized any loss I would have taken in long positions. There was no swing short opportunity in market ETFs, but I could take intraday trades effectively. Now let's look at the sector industry stock level. Let's look at the bucket analysis. Bucket analysis takes all the S&P 1500 stocks, not 500, 1500 stocks. Take each stock one at a time, divides that stock's normal range using standard deviation into 10 buckets, and depending on where price is relative to the normal range, it drops the stock in one of these 10 buckets. If price is above normal range, it drops in the 11th bucket greater than 10. If price is below normal range, it drops the stock in the 12th bucket less than 0. So there are 12 buckets. 10 of them are equidistant buckets, and then one at the extreme high, one at the extreme low. Each stock is placed in one of these buckets. Once all the stocks are placed, percentage is calculated, what percentage of stock is there in each bucket, and that is plotted as a bar chart. There are two colors for each bucket. One is the dark colors, that is green and red, that is for the current date, and the lighter colors, light green, light red, that is for the previous day, D1 versus D2. That shows how price is moving. This bucket inside the buckets. This is a very powerful aggregate tool. Again, I saw Dr. Jeffrey using it, and he asked me if I could incorporate it in QH. QH is a powerful tool because it does everything in real time, and I was able to incorporate it. Now there are several insights from this. One is when to know whether the market is bullish, bearish, or balanced. Now if you look at the overall histogram pattern, it is balanced. Some bearish, some bullish, in fact more on the bullish side. If we look at the percentage bucket analysis, 51% is above midpoint. So it's 50-50, you may say. It's evenly balanced. That is overall view. The bucket analysis show market is evenly balanced, neither bullish nor bearish. Now when does it start to pull back? Under two circumstances. One is using real-time move when you see that the percentage of stocks in the extreme bucket has jumped by 10%, 15% or more. And in recent days that has happened several times, and I tweeted about it, I talked about it in other YouTube live sessions, that the percentage of stocks in the not normal extreme bucket was jumping up by 10% or 15% like that in one day. That was a sign of heating up, things heating up. at that time the percentage of stocks in the extreme bucket was not yet at 30% level, and I noted, I think in the last webinar, that there was some distance to go. And after my last webinar using intraday real-time chart, it in fact hit the 30% level, and again I tweeted about it right at that time. When it goes to 30% level, it tends to pull back, and when it jumps by 10%, 15% or more in a day, it tends to pull back. Both of those situations happened before the market started to pull back in last couple of days. I pointed out about that on Twitter, YouTube, and if you are using Q systems, you could observe that in real time and use that insight to be cautious, not keep on taking long trades. Instead, protect profit in long trades and probably, like me, hedge my position by taking some short trades. That that worked very well. Now, if we look at the sector industry stock breadth using the very useful 1 month to 1 day sector industry stock advanced decline picture, now the 1 day period is bearish, red color more is bearish, 2 day period bearish, 5 day we have to say slightly bearish. Sectors are looking much more bearish, but industry level 50-50 stock level is slightly bearish also, is slightly more bearish than bullish. 10-day period is even, and 1 month period is remaining bullish for a long time. Now this has happened in the past, and I mentioned that in the video YouTube live sessions, that 1 day, 2 day, and now I see even 5 day has turned bearish only to turn back up. Can it happen again? It can happen. Why I say it can happen? Because we don't have distribution count of 2 yet on Q global market breadth, and several market instruments are having trendline support. We'll see if that repeats itself, what happened in the past, or does the 10-day and 1 month, do they also go down and turn bearish? We'll have to see. Right now there is no indication other than the bucket analysis showing that it was overheated. There was time for a pullback. Has the pullback happened? Will the trend lines hold? We'll have to see. Now Q Finder also gave us some warning. Remember I mentioned to keep two things in the back of our mind. One was the overheating shown in the bucket analysis, the percentage of stocks in the extreme bucket. Another thing I mentioned was the number of bearish headwind signals in the weekly interval in Q Finder. Q Finder shows the balance between bears and bulls, and whenever there is a large number of bearish headwinds, market tends to pull back. That time it was not so high. It was getting higher, and that was a warning sign, and see now it is much bigger number, 193. So that is also bearish. Another thing I pointed to that was a caution was that we were seeing bullish strength signals associated with bearish reversals, and that tends to be even more bearish than simple reversal signals. If we have simple reversals, that is bearish, but if market makes a false move to the upside, more strength, usually due to gap ups, lures you to the upside and then reverses sharply, that is even more bearish than simple reversal signals. This is the same concept in aggregate that I apply to charts in terms of false up or downside breakouts at watermark levels, especially when the bearish headwinds are there at the same level. The same concept in aggregate, large number of stocks showing bullish strength and then showing bearish reversal, that is bearish. The bearish headwinds were also bearish. Another weakness I pointed out in the daily, but before going to the daily, let's summarize. The weekly interval overall is bearish. Strength is bullish, but again I mentioned bullish strength associated with bearish reversal is actually even more bearish. So overall, this weekly finder picture is bearish. And daily picture yesterday is also overall bearish, 74%. Strength signal 94% bearish because of large number of gap down. Trend continuation 76% bearish. And see why it is possible that market will reverse is that in the daily interval I see bearish strength followed by bullish reversal opposite to the weekly interval picture, and it is happening right at trend line support for the mega cap top 20, right at trend line support for the market ETFs. So it is possible that these reversals will hold at least for a day or two, or market may move sideways for a few days around the memory trend lines before it makes up mind whether to bounce up from there or go down from there. Still, overall, if we look as of today, the daily picture and weekly picture are more bearish than bullish. Another alert signal that finder flashed earlier, I showed that earlier. At that time, the price level for the bullish signals, you see now price level for bullish signals only 28% is at pendulum high, but the alert came when I saw it was about 70% at pendulum high for the bullish signals. When most of the bullish signals are coming from stocks that are already at pendulum high, that is also an aggregate alert signal. So we had multiple aggregate alert signals. One was the number of bearish headwinds in weekly interval. One was bullish strength associated with bearish reversals in the weekly interval. We saw large number of bullish signals, about 70% or so, coming from pendulum high at that time. Those were the alerts in Q Finder, and in Q Edge in bucket analysis we saw several days percentage move in the extreme bucket was more than 10%, and eventually it did go up to 30% plus. Those were alerts that helped us be cautious. The market is still not bearish. It is continuing show alert, the finder more than others, but there is no other bearish signal. The buckets have now pulled back. Bucket percentage of stocks in the extreme bucket. So bucket is not flashing any warning signal now. The warning signal is remaining only in Q Finder. I am at the 1 hour point. I didn't look at any stock, but that is fine. Let me look at Q Edge. Okay, let me take 5 minutes to see is there any easy trading opportunity. Let's go to Q Vital. I have, and I think all Q traders, they maintain their stock universe here. I tend to maintain broad universes like stocks with liquid options or just liquid stocks or mid-price stocks. Let's take the liquid stocks, and I released the seasonality tool recently. Let's check seasonality of the stocks with liquid options. Because I selected instrument list, I have both the programs open, Q season and Q seasons. It sent me to Q seasons to retrieve data on all these stocks. No data is stored on my computer. It calculated the seasonality. Let's go to the seasonality table. We are in the month of May. Let's look for most bullish seasonality by clicking this cyan button. These are the stocks having 80% or more bullish seasonality. But you see, none of them have data more than 10 years. So I'm not going to work on them. I may highlight them. No need to highlight. Let me go to the next level. Let me look for stocks with green bullish seasonality, not cyan, that is above 70%. We don't look at percentages, actual numbers. Actually, I don't do. Just look at the colors. And I'm using the 10 button to restrict stocks that have at least 10 years of history. Okay, none of them actually have 10 years history. I see all are, or there are few. Okay. Let's click the 10 button and then click the green color button again. I'm left with only two stocks, KO and ON. KO is Coca-Cola, ON we'll have to see what it is. Both of them have more than 70% bullish seasonality in the month of May, and they have more than 10 years of data. Coca-Cola is up this month, ON is down this month. Coca-Cola up slightly 0.6, ON down minus 4.7. Let's look at Coca-Cola because that is up. Let's look at its detail seasonality picture. In the month of May, it has 73% bullish seasonality. Average move over 30 years. Here I set the parameter for 30 years retrieval, data retrieval. So it is showing me 30 years of data, 22 years up, 8 years down in May. Average over those 30 years gain is 3.1%. Average when up is 5.1, average when down is smaller, 2.5. So these ratios favor taking a long trade, these percentages. Not only the seasonality itself, but these percentages favor taking a long trade. And if you look down and look at the metallic colors, they look metallic to me. The green ones are the years when it moved by a percentage that is greater than average when up. Average when up is 5.1%, and you can see it did move by 5.4, 14.2, 12.8, 13. Many years it moved by a bigger percentage. So that also tells us we are allowed to take a long trade in Coca-Cola KO based on seasonality. On the right edge, you can see in terms of yearly performance, 74% bullish seasonality, average gain for the last 31 years. Average gain is 8.7%, average when up yearly performance 15.5, average when down 10.8, and sometimes when up it is up by bigger than average when up by 16%, 15, 24, 25, 18, 16, 28, here 44%, 37, 35, big percentage gains. Now in the last 30 years or so, Coca-Cola has gained by total 270%. So Coca-Cola may be a stock we may look at. Let's look at its fundamentals. So I'm clicking the Q Vital button to check its fundamental scorecard. We may not find a bullish trade, but I'm explaining how to use all these systems together to carry out industry rotation analysis, fundamental analysis, seasonality analysis, technical analysis together. Coca-Cola, this stock pays a dividend 3%, decent dividend, makes money. Let's check its industry from Q Edge. Soft drinks industry relative score improved, that is bullish. That is 5 days, 2 days, 1 day period. The relative score improved, that is bullish. And the percentage move itself was down over 5 days, was down over 2 days. Yesterday it went up, that is bullish. If you look at the alternative industry score and performance, that also went up, that is bullish. If we want to look at the rotation over longer time from the rotation scorecard, clearly bullish. It was magenta color earlier, turned cyan over last 2 days and 1 day, and it showed acceleration as well. These pairs of numbers at the top that shows how many industries went up, how many went down. Yesterday only 32 industries were up, 115 were down. Coca-Cola was relatively strong. That relative strength is shown by the cyan color. Was it actually up Was it one of these 32 industries? We can check that from the industry percentage tab. Yes, yesterday soft drinks industry was actually up by 0.4%. Not only was it relatively strong, it was up as well. Let's go back to Q Vital to check the scorecard. Medium valuation with not very large but gradual earnings growth increase from minus 1.8% to 6.8% to 7.8%. So gradual earnings growth increase, and in the last quarter increase in revenue growth also. So the fundamentals not great. Again, it's a consumer staples stock. It's a defensive stock. So if market is looking weak, this stock may be a better buy than high growth stocks. Also pays a dividend of 3.09. So it is possible to buy based on these fundamentals. Has some acceleration in earnings from negative to positive. Revenue growth also accelerated in the last quarter, has dividend. Last step is to look at its technical charts. Let's click the chart icon to open it in Q Global and look at it using weekly, daily. We don't have any buy setup at the right edge. It came close to the upper boundary on Monday, displayed the indecision at the top, then came down yesterday. Again, it stopped at the trend line support. Displayed a bear release, red candle yesterday, reversed below the weekly watermark resistance, displayed bear release, created a false upside breakout in weekly. All those are there. However, it stopped at trend line support. There are other trend line supports. This is what I was mentioning earlier. It will not be easy to find bearish trades when we see there are memory trendline supports in multiple market instruments, not only in USA, in global markets also. Of course, for USA trading, we'll use the USA market instruments. They're having trendline support, and when that happens, many stocks will also have trendline support, just like Coca-Cola. So we are not going to short it. If price goes up from here using intraday chart, one might even buy it using intraday, using weekly, daily swing trading trade setups. There is no trade setup, but if price goes up from here, one may rely on the trend line support to take extremely low risk intraday, just like I took trades in dia, just like I took trades in IWM. This trend line supports hold very well, so it is possible to take a long trade. Fundamentals are okay for a defensive stock, consumer staple stock. Industry looking much better than the others, and even seasonality favors taking a long trade. Technically, intraday trades are possible. That is how you combine all the systems together. Everything is 100% real time. We'll see how the market does. I am not probably going to look for short trades now using swing trading techniques because of the market instruments trendline supports. Also, there was no distribution count of 2, and I will be cautious about taking long trades unless they are in defensive stocks with proper trade setup. I'm sure there are trade setups like that. I don't have time to look for them. You may carry out either a top down or a bottom up or fundamental first or seasonality first workflows to easily find them out. Probably at least advisable from Q technique. Log them on Q diary, plan them and log them there, and then take the trade. You will find trades in every market situation that are low risk, high probability. I'm sure, and I'm sure you know that also if you are using Q systems for a while. Let's end today's session here. I think I managed to finish today without any audio trouble. Thanks a lot for attending. I look forward to seeing you again in our next session. That will be most likely during the weekend. I'll announce the exact date time on Twitter, and if you are subscribing to YouTube channel, you will get notification from YouTube also. Thanks once again. Keep safe, and as I always say, no reason not to do so. Trade profitably.